What if I told you that right now, today, there are nearly 6 million more Americans who can afford to buy a home than there were just 1 year ago? That's not a projection. That's not a forecast. That's data from this week. 30-year mortgage rates just hit 6.01%, the lowest level since September 2022. And what that means for your business is something every loan officer and real estate agent needs to understand right now. I'm Mike Vrlaku. I've been in the mortgage business for over 20 years and funded over $1 billion in loans. Every week, I take the latest market data and break it down into exactly what you need to do to serve your clients better and grow your business. Today, we're covering the NAF Insights report released this week, one of the most actionable reports we've had in months. Let's get into it. Let's start with the headline number because it's more significant than most people realize. The 30-year fixed rate averaged 6.01% last week, according to Freddie Mac's primary mortgage market survey. That's the lowest it's been since September 2022. Now, I know what some of you are thinking. Mike, 6% still feels high compared to the 3% rates from a few years ago. You're right, it is higher than that. But here's what the data actually tells us about what 6% means for your market. The National Association of Home Builders tracks affordability thresholds. How many American households can actually qualify to buy the median-priced home at any given rate? Here's what changed. At 7% rates, 41.6 million households could afford the median-priced home. At 6% rates, that number jumps to 47.4 million households. That's nearly 6 million more potential buyers, unlocked by a single percentage point. And if rates were to fall to 5%, an additional 5.5 million households beyond that could enter the market. So every time rates drop, even a little, we're not just talking about slightly lower payments. We're talking about unlocking entire segments of buyers who were priced out before. That's your pipeline. That's the opportunity sitting in front of you right now. When clients see lowest since 2022, rate psychology shifts and urgency returns. That's as real as the payment difference. Use both. Let's talk real dollars, because that's the conversation that moves people off the fence. The estimated total monthly mortgage payment in the U.S., principal, interest, taxes, and insurance, came in at $2,134 in January 2026. Here's the context. Down 7% from the recent peak, down 6% from this time last year, still up 43% from January 2020. But the direction of travel has changed, and direction matters. The markets showing the biggest relief are in the Sun Belt. And if you work in any of these areas, these numbers are powerful to share with your sphere right now. Austin, TX, down 12.4% year over year in total monthly costs. Tampa, FL, down 11.0%. Orlando, FL, down 10.1%. Miami, FL, down 10.0%. Phoenix, AZ, down 9.8%. Now, an important context because I'm always going to give you the full picture. Even with these declines, payments in many of these markets are still 30 to 40% above their 2020 levels. The message isn't, we're back to normal. The message is, it's getting better, meaningfully better. And for buyers who've been waiting, right now may be the best window they'll see in the next 12 months. Here's something most people in our industry are completely sleeping on, and it represents one of the biggest untapped opportunities in the market right now. Young buyers are coming back. The homeownership rate for borrowers under 35 has bounced from 36.3% back up to 37.9%. The trend has reversed and it's moving in the right direction as affordability improves. Now pair that with where the fastest household growth is happening. According to the U.S. Census Bureau, here's what Q4 2025 data shows. Hispanic households growing at 6.33% year over year, the fastest of any group. 2 or more races households growing at 9.59%. By comparison, white alone and black alone households are seeing flat or declining growth. What does this mean for you? The buyer pool is changing. The clients who will be driving housing demand for the next decade look different than the clients many of us built our businesses around. Loan officers and agents who build relationships now in Hispanic, multiracial, and younger buyer communities are positioning themselves for the next wave of homeownership growth. That's not just good strategy. It's how we make homeownership actually accessible to everyone it should be for. Also worth noting, the Midwest, homeownership rates there just hit a 16-year high of 71.3% compared to the national rate of 65.7%. Relative affordability and limited inventory have kept demand strong. If you have clients considering relocation, that conversation is worth having. Quick reality check before we get to strategies, because my job is to give you the full picture, not just the headlines. Right now, 65% of American households are still priced out of the median-priced home. Nearly 2/3 of the country cannot afford the median house. That's not doom and gloom. That's the market we're working in. The most constrained states, where over 80% of households can't afford the state median, include New Hampshire, Hawaii, Maine, Alaska, and Connecticut. The most accessible markets remain in the Midwest and parts of the South, where home prices relative to local incomes still make homeownership achievable. The opportunity is real, but it's nuanced. Your job is to help clients understand both the progress and the reality, and find the path that works for them given today's conditions. That's what separates trusted advisors from salespeople. All right, let's make this actionable. Here are 5 things you should be doing this week based on everything we just covered. Strategy 1. Pull your not yet list and run the new numbers. Every one of us has a list of clients who said not yet in the past 12 to 18 months. Some were waiting for rates to drop, some were saving more, some just weren't ready. Take the top 5 to 10 people on that list and run a simple comparison. What did a $400,000 home cost monthly at 7%? What does it cost today at 6%? For most people, that's a $300 to $400 per month difference. That's a car payment. Don't ask if they're ready to buy. Show them the numbers and let the numbers do the asking. Strategy. 2. Get specific about your local market. Generic market updates don't move people. Local data does. If you're in Austin, Tampa, Miami, Orlando, or Phoenix, lead with that number. Did you know monthly mortgage costs in our market are down over 10% from last year? That's a conversation starter. If you're not in a Sunbelt market, dig into your specific city's data. NAF's data goes to the metro level. Use it. Be the professional in your market who knows the local story cold. Strategy. 3. Create content for the under 35 buyer. Right now, buyers under 35 are coming back into the market. These are first-time buyers who need education, guidance, and a professional they can trust. Create one piece of content this week: a video, a post, an email, specifically for first-time buyers. Explain what 6% rates actually mean in plain English. Walk them through what they need to qualify. Highlight assistance programs in your market. These buyers will be referral sources for the next 20 years. Investing in them now is one of the highest ROI moves you can make. Strategy. 4. Build relationships in growing communities. Hispanic households are growing at 6.33% year over year. Multiracial households at nearly 10%. These communities represent the future of housing demand. If you don't have relationships there, it's time to build them. Partner with a community organization. Create content in Spanish. Attend a cultural event. And make sure your lending partner has the products, the language capabilities, and the cultural understanding to serve these clients well, because not every lender does. Strategy 5. Pre-qualify buyers, now before rates move again. Rates dropped, but they won't necessarily stay here. We have a new Fed chair coming in May, an uncertain economic backdrop, and bond market dynamics that could push rates in either direction. The smartest thing you can do for clients right now is get them pre-qualified based on today's rates, lock in their buying power. When they find the right home, they're ready to move, not racing against a rate environment that may look different 6 weeks from now. Build your bench now. Be ready. Here's the bottom line from this week's data. Affordability is improving, the buyer pool is growing, and the markets are rewarding the professionals who show up prepared. The question isn't whether there's opportunity out there. There clearly is. The question is, are you positioned to capture it? If this breakdown gave you real, actionable intel you can use this week, here's what I'd ask. Subscribe. We drop this analysis every Friday. Share this with one partner, an agent, a fellow LO, someone who needs to see this data. Drop a comment below. What's your market doing right now? Are buyers coming off the fence? I read everyone. Next week, a new Fed chair is taking the reins in May, and it could change the rate trajectory you've been counting on. We'll break down what 𝗪𝗏𝗄𝗎's nomination means for mortgage rates, your pipeline, and how to position your business before things shift. You don't want to miss it. I'm Mike Vrlaku. Markets change. Your value to clients doesn't have to. I'll see you next week.